They built the wall at $32, not a physical wall, a digital fortress of sell orders stacked so deep in the futures market that it was supposed to be impossible to break through. The banks positioned this defense on December 18, 2024, right as retail momentum was building. They waited until Asian markets closed, when volume thins out, when they thought we'd be weak. But when New York opened this morning, December 27th, that $32 resistance shattered like glass. Silver didn't just break through, it exploded to $33.85 in the first 2 hours of trading. And here's what they don't want you to realize. This wasn't supposed to happen for another 6 months. The entire banking cartel's strategy just collapsed in real time. They took their best shot. They used every tool in the manipulation playbook. Margin hikes, coordinated sell orders, media blackouts on the industrial shortage. But the sell wall failed. And now, for the first time since 2011, the banks are genuinely panicking. This is not a drill. While the mainstream financial media is obsessing over Bitcoin breaking $100,000 and the Federal Reserve's latest rate decision, the real story is unfolding in the silver market, and it's a lie of omission so massive it borders on criminal negligence. Here's what they're not telling you. The physical silver market has completely decoupled from the paper futures market. Right now, today, you can buy a silver futures contract on the COMEX for $33.85 per ounce. But try to buy 1,000 ounces of physical silver for immediate delivery. You're paying $37.50 to $39 per ounce, a premium of nearly 15%. This spread hasn't been this wide since March 2020, when the entire supply chain collapsed during COVID lockdowns. But this time, there's no pandemic. This time, the shortage is structural, industrial, and accelerating. Samsung just announced they're stockpiling 6 months of silver inventory instead of their usual 45-day supply. Tesla's Gigafactory in Texas is operating under allocated silver shipments. They're being rationed. First Solar quietly secured a 3-year forward contract with Coeur Mining at prices Wall Street analysts say are commercially insane. They want you to believe this is just another commodity cycle. They want you watching crypto while the greatest wealth transfer in precious metals history unfolds in the shadows. This matters right now because we are witnessing the endgame of a 60-year manipulation scheme, and the collapse is happening faster than anyone predicted. On December 12, 2024, the Silver Institute released their annual World Silver Survey with a bombshell buried on page 47. Industrial demand will exceed total mine supply by 215 million ounces in 2025. Not deficit. Deficit is when demand exceeds supply plus recycling. This is demand exceeding mining output entirely. To put this in perspective, the entire COMEX registered inventory, the silver actually available for delivery, sits at 42 million ounces as of this morning. Do you see the problem yet? Industrial users need 215 million ounces that don't exist in above ground available for sale inventory. But here's the kicker. The banks are still net short 110 million ounces in the futures market, according to the latest Commitment of Traders report from December 20th. They're contractually obligated to deliver silver they cannot source at prices that are already underwater. JP Morgan, HSBC, and Scotiabank, the 3 largest silver short holders, are trapped. And when trapped banks start panic covering, prices don't rise. They explode. We're not talking about $40 silver. We're talking about $80, then triple digits, in a time frame measured in weeks, not years. In this deep dive, we are going to expose exactly how the banking cartel's control grid is collapsing in real time. We're going to look at the 3 forces converging to create what some analysts are calling the perfect squeeze: industrial demand destruction, government stockpiling, and a derivatives time bomb that makes the 2008 mortgage crisis look simple. We're going to explain how the paper silver market was designed to suppress prices, why that mechanism is breaking down right now, and what Wall Street banks are doing behind closed doors to survive what's coming. We're going to show you the exact playbook they used in 1980 to crush silver from $50 to $8, and why that playbook cannot work this time because the fundamental supply-demand dynamics have permanently shifted. And most importantly, we're going to give you the strategic roadmap to position yourself before the mainstream financial media finally admits what's happening. And by then, it'll be too late for average investors to get in. This is the story of how digital manipulation collides with physical reality, and why physics always wins in the end. To understand why this matters, you have to understand how the silver price is actually set, and it's not what you think. Most people believe silver prices are determined by supply and demand, buyers and sellers meeting in a marketplace. That's technically true, but there's a massive catch. The marketplace is 97% paper contracts that never involve physical metal. Here's how it works. The silver price you see on Bloomberg, CNBC, or your trading app comes from the COMEX Futures Exchange in New York and the London Bullion Market Association. These are centralized exchanges where banks and traders buy and sell futures contracts. promises to deliver silver at a future date. The critical detail: you can sell futures contracts for silver you don't own, don't have, and have no plan to acquire. This is called naked shorting in other markets, but in commodities futures, it's perfectly legal and happens every single day. Think of it like this. Imagine a concert venue with 5,000 seats. Now imagine Ticketmaster selling 150,000 tickets to the same show. As long as most people sell their tickets back instead of actually showing up, the scam works. The venue never fills, and nobody realizes tickets vastly exceed seats. But the moment people start showing up demanding entry, the entire fraud collapses instantly. That's the silver market right now. The concert hall is full, people are still arriving, and the fire marshal is finally asking questions. Let's do the math. The total annual silver mine production in 2024 was approximately 842 million ounces, according to the Silver Institute. That sounds like a lot until you break down where it goes. Industrial applications consumed 539 million ounces. That's photovoltaics, electronics, medical devices, 5G infrastructure, electric vehicles. Jewelry and silverware took another 186 million ounces. Investment demand, coins, bars, ETFs, absorbed 267 million ounces. Add it all up, and you get 992 million ounces of demand against 842 million ounces of supply. That's a deficit of 150 million ounces before we even talk about government stockpiling or what China is doing in the shadows. So where does this come from? Recycling provided about 164 million ounces, and above-ground inventories filled the gap. But here's the critical issue. Above-ground inventories are nearly depleted. The U.S. Mint has already suspended production of certain silver coins twice in 2024 due to blank shortages. The Perth Mint in Australia is running 8 to 12-week delays on silver bar orders. Kitco, one of North America's largest bullion dealers, has premiums on silver eagles at $6.50 over spot. That's 19% above the COMEX price. Do you see the problem yet? This deficit isn't theoretical. It's happening right now in the physical market. But the paper market, the futures exchanges, are still trading as if unlimited silver exists. On December 20th, the open interest on COMEX silver futures was 170,000 contracts. Each contract represents 5,000 ounces. That's 850 million ounces of paper silver claims. But the registered COMEX inventory, silver allocated for delivery, is only 42 million ounces. That's a leverage ratio of 20 to 1. For every ounce of silver that actually exists in deliverable form, there are 20 paper claims on it. This is the float, the metal available for sale, not the total inventory. And when industrial users start demanding physical delivery because their supply chains are breaking, this 20 to 1 leverage ratio becomes a doomsday mechanism. This is exactly what happened in January 2011, and if you weren't trading metals back then, you need to understand this pattern. Silver had rallied from $18 in September 2010 to $31 by December. Retail investors, especially after the financial crisis, were piling into precious metals as protection against currency debasement. The banks were massively short, and the squeeze was building. Then, on January 7, 2011, the CME Group, the exchange that operates COMEX, suddenly raised margin requirements on silver futures by 12%. Then they did it again on January 13th. Then again on January 24th. 5 margin hikes in 3 weeks. This forced leveraged traders to either deposit more cash or close their positions. Thousands of retail traders were liquidated instantly. The price crashed from $31 to $26 in a matter of days, even though the underlying supply-demand dynamics hadn't changed at all. The manipulation was so blatant that a class action lawsuit was filed, and years later, banks paid settlements without admitting wrongdoing. The classic legal playbook. But here's the key difference between 2011 and today. Back then, the deficit was manageable. Industrial users could absorb the volatility. There was still buffer inventory in the supply chain. Today, there is no buffer. The deficit is structural and growing, so when they try the margin hike playbook again, and they already tried on December 9th, the physical market just ignores it. History is repeating itself, but this time the ending is different. This creates a derivative death spiral that has no elegant exit. When industrial users realize paper contracts are worthless for securing actual metal, they stop trading futures and start negotiating directly with miners, refiners, and sovereign mints. This removes liquidity from the futures market, which makes prices more volatile, which triggers more margin calls, which forces more liquidations, which removes even more liquidity. It's a feedback loop. And at the center of this loop are the bullion banks, JP Morgan, HSBC, Scotiabank, who are contractually short 110 million ounces they cannot deliver at prices that are already below their cost to source physical metal. If they try to cover their shorts by buying futures, they drive the price up, which increases their losses on existing short positions. If they don't cover, they face default when industrial users demand delivery. It's a trap within a trap. And the escape hatch, the ability to cash settle contracts instead of delivering metal, only works if both parties agree. If Samsung demands physical silver and the bank offers cash, Samsung can refuse and demand delivery. In Part 3, we're going to look at exactly who's applying this pressure and why they can't back down. If you're the Chinese government and you're watching the West pivot to green energy, electric vehicles, and advanced semiconductor manufacturing, all of which require massive amounts of silver, you have two choices. Option A, compete for silver on the open market at whatever price Western industrial buyers are willing to pay, knowing that prices could spike and cripple your domestic manufacturers. Option B, stockpile now, quietly, using state-owned enterprises and offshore purchasing arms, before the shortage becomes obvious to Western competitors. China chose option B in 2022, and we're only now seeing the evidence. According to shipping data analyzed by Reuters in November 2024, Chinese imports of silver reached 7,200 metric tons in the first 10 months of 2024, up 62% year over year. But here's the kicker. Domestic Chinese silver mine production only fell by 3% during the same period. So where's the imported silver going? It's not showing up in Chinese jewelry exports. It's not appearing in visible industrial consumption statistics. It's vanishing into what analysts call undisclosed reserves, a polite term for state stockpiling that isn't reported to international commodity tracking agencies. This is resource nationalism in action. Countries restricting exports and hoarding strategic materials. China already controls 70% of global rare earth processing. They learned from the 2010 rare earth embargo against Japan how powerful resource dominance can be. Now they're applying the same playbook to silver, and every ounce China takes off the global market is one less ounce available for Western industry. While China was quietly stockpiling, Western industrial manufacturers were operating under the assumption that silver would always be available at reasonable prices because it always had been. That assumption shattered in October 2024. First Solar, one of the largest solar panel manufacturers in North America, did something unprecedented. They signed a 3-year forward purchase agreement with Coeur Mining for silver delivery at $38 per ounce, according to an SEC filing from October 18th. At the time, spot silver was trading at $31. Wall Street analysts called the deal commercially insane. First Solar was agreeing to pay 22% above market price for future delivery. But here's what Wall Street missed. First Solar wasn't paying a premium. They were paying insurance. They were guaranteeing supply at a fixed price because they know what's coming. Samsung made a similar move, increasing their silver inventory buffer from 45 days to 6 months, a 300% increase in working capital tied up in metal. Why would a company voluntarily increase inventory carrying costs unless they believed silver would be unavailable at any price? Tesla's Gigafactory in Texas is now operating under allocated shipments from their primary silver supplier, according to an internal memo leaked to Bloomberg in November. They're being rationed. When was the last time you heard about a major automotive manufacturer being rationed on a raw material input? This isn't normal market tightness. This is industrial users realizing the paper market is a fiction and scrambling to secure physical metal before the music stops. This isn't just Chinese stockpiling. This isn't just industrial panic buying. This is Chinese stockpiling plus industrial panic buying plus investment demand plus a banking short position that was built when silver was $18 per ounce and is now underwater at $33, all happening at once. Think of it like a pincer movement in military strategy. The banks are being squeezed from 3 directions simultaneously, and there's no escape route. From the east, China is removing 7,000 metric tons annually from the global market. That's 225 million ounces that Western industry can't access. From the industrial sector, companies are forward buying and stockpiling another 150 million ounces beyond normal just-in-time inventory practices. From the investment side, retail buyers and institutions added 267 million ounces in ETFs, coins, and bars in 2024, the highest since 2020. Add it all up, 225 plus 150 plus 267, 642 million ounces of demand, pulling from a market that only produced 842 million ounces. And that's before we account for jewelry, silverware, and other traditional uses. The math doesn't work. The banks are sitting in the center of this perfect storm, holding massive short positions, and the walls are closing in. They can't deliver the metal. They can't cash settle because industrial users will refuse. They can't cover by buying futures because the premium to physical is already 15%. And buying would send prices to $50 instantly, triggering margin calls across the entire sector. We are already seeing signs of this system breaking in real time, not in theory. On December 4, 2024, the U.S. Mint announced it was temporarily suspending sales of 2024 Silver Eagles due to supply chain constraints with silver blank suppliers. This is the same mint that sources silver from domestic producers and has government priority and supply allocation. If the U.S. government can't get enough silver to mint coins, what chance do private industrial users have? On December 11th, Sprott Physical Silver Trust, one of the largest silver-backed ETFs, reported a 14-day delay in acquiring allocated silver bars to meet new share creation demand. The trust is legally required to hold physical silver backing every share, but the metal is taking 2 weeks to source instead of the standard 2 days. On December 19th, the LBMA, the London Bullion Market Association, held an emergency meeting with member banks to discuss liquidity concerns in the silver forward market. The minutes weren't public, but 3 separate sources leaked to Bloomberg that banks are struggling to source silver for delivery against maturing forward contracts. This is the institutional plumbing starting to freeze. And just yesterday, December 26th, COMEX registered silver inventories dropped to 41.8 million ounces, the lowest level since August 2022. That's the physical backing for 850 million ounces of paper claims. The evidence isn't hidden. It's right there in the data. The question isn't whether the system is breaking. The question is how fast and who gets caught holding the bag when it collapses completely. Here's what you need to understand. We are in the early stages of a price discovery event that will redefine the silver market for the next decade. If you've been stacking silver, whether coins, bars, or mining stocks, you are positioned ahead of 99% of Wall Street. The institutional money hasn't arrived yet. Hedge funds are still treating silver like a commodity trade, not a strategic resource. But that's changing right now, today, as industrial users break rank and start paying premiums that prove the paper price is fiction. The window for accumulating physical silver at reasonable prices is closing faster than most people realize. Premiums are already at 15% over spot. By the time the mainstream financial media admits there's a shortage, premiums could be 30%, 40%, or higher, assuming metal is even available. We saw this exact dynamic in gold during the March 2020 crisis, when premiums spiked to 25% and dealers simply stopped taking orders. The FOMO phase of this market hasn't even started yet. Right now, you're still early. You're still able to acquire metal at prices that will look absurdly cheap within 6 months. But here's the reality. This opportunity evaporates the moment silver breaks $40 and mainstream financial shows start running segments on the shortage. By then, it's too late to get positioned. You'll be buying at the top from the early stackers who understood the game. Strategy number 1. Prioritize physical metal over paper exposure. If you're buying silver, buy actual metal. Coins, bars, rounds, not ETFs, not futures, not mining stocks as your primary position. ETFs like SLV can be cash settled in a crisis. Futures contracts can be margined out of existence. But a 1-ounce silver maple leaf in your hand is an ounce they can't manipulate, confiscate, or paper over. Buy 100-ounce bars if you're allocating serious capital. Premiums are lower than coins, and liquidity is still excellent for large bars. Avoid collectibles, numismatics, or high-premium specialty coins. This isn't about aesthetics. This is about securing ounces at the lowest possible cost basis. Strategy number 2. If you're trading mining stocks, focus on primary silver producers, not silver as byproduct miners. Companies like First Majestic Silver, Fortuna Silver, and Hecla Mining derive 50% or more of their revenue from silver. When silver moves from $30 to $60, these companies don't just double. Their profit margins explode because mining costs are largely fixed. A company with $20 all-in sustaining costs sees profits go from $13 per ounce to $40 per ounce. That's a 207% increase in profitability on an 81% increase in silver prices. Leverage works in your favor with quality producers. But avoid explorers, developers, or juniors with no revenue. In a short squeeze, only producing companies capture the full price move. Strategy number 3, dollar cost average into positions, but accelerate your accumulation timeline. Don't wait for a pullback that may never come. If your plan was to buy 500 ounces over the next year, compress that timeline to the next 3 months. Yes, you'll pay slightly higher prices than you would have in October, but you'll be fully positioned before the breakout, above $40 that triggers institutional FOMO. The goal isn't to buy the absolute bottom. That's impossible. The goal is to acquire your target position before the asymmetric move that reprices silver from $30 to $80 in a matter of weeks. Next week will be brutal, not for the price, but for your emotions. The banks will attempt one final shakeout before they capitulate. They always do. They will coordinate a sell-off into thin holiday trading volume, drop silver $3 in a single session, and flood financial media with headlines about silver bubble bursts and retail loses again. This is psychological warfare, and it's coming. They will try to shake you out right before the moonshot, exactly like they did in 2011, exactly like they did in 2020. Do not give them your medal at the bottom of a manipulated drop. Here's your mental framework. If you believe the thesis at $33 and the industrial deficit has only gotten worse and Chinese buying has only accelerated, then a drop to $30 isn't a reason to sell. It's a gift to buy more. If you held silver through December, you understood the game better than 99% of traders. If you panicked and sold during the December 9th margin hike shakeout, you were the liquidity that allowed smart money to accumulate. The next 2 weeks will test your conviction harder than any price chart. We are living through a historic pivot point in the commodities supercycle, and silver is the apex leverage play. While mainstream finance argues about the Fed's next 25 basis point rate decision, the real story is the collapse of financialized commodity markets into physical reality. For 60 years, banks have controlled silver prices through paper derivatives, using leverage and market manipulation to suppress a strategic industrial resource below its true value. That control grid is breaking right now in real time because you cannot print physical silver, you cannot rehypothecate it infinitely, and you cannot deliver contracts with metal that doesn't exist. Physics is overruling finance. Supply and demand are overruling derivatives. And the banks that built this system are about to learn an expensive lesson. When industrial users need physical metal for production, paper promises become worthless. Congratulations to the diamond hands who held through the December shakeout. Congratulations to the stackers who understood that premiums are the real market price, not the COMEX fiction. You were right. You are ahead of the institutional curve. You positioned yourself before the mainstream woke up. And in 6 months, when silver is trading at $70, $80 or higher, and financial media is finally explaining the shortage you already knew about, you'll be the smart money taking profits while late-stage FOMO buyers are just getting in. The sell wall just failed. The banks are in retreat. And the greatest wealth transfer in precious metals history is just beginning. This is your moment.